Calculating the intrinsic value of a company like Warren Buffett is actually easy when you understand the process. And that's why I've created a free template that you can utilize. So in this video, I will guide you step by step through its use, and I will teach you how to calculate the intrinsic value of a company all by yourself, following Warren Buffett's principles. Hi all and welcome to my channel. I'm Nick and I'm an investor since more than 10 years. And on this channel, I share my experience, my knowledge, in order to help anyone improve their finances. And 10 years ago, when I started to invest, one of the things I noticed actually is that there aren't tools to calculate the intrinsic value of a company, or at least none that really went in depth in the calculation. And I see that still now there aren't. And since I developed my own investment tool to follow Warren Buffett's principle when I invest, I just want to share it with you all so that you can do the same very easily. And so the main difference of this tool with the other tools that you might find on the internet is actually that the intrinsic value of this calculator will be much more reliable than the others, because the analysis goes much more in depth, because it doesn't only use the current data as most of the tools that you can find on the internet, but also all the historical data of the company you're looking for which you're calculating the intrinsic value. And so firstly, to start, we really have to understand what are market value and intrinsic value. And so the first one is very easy. It is the value that the market, and so the people investing, gives to a company. And so for example, Apple now has a stock price of $177, and you multiply it by the number of stocks of Apple on the market, which at the moment is just lower than 16 billion, you will have the market value of Apple, which at the moment, for example, is 2.8 trillions. And so it's very simple, but this actually doesn't really represent the real value of the company, because if you think about it, like you go to an auction and you want to buy something and you just say the price, you think the object is valued. And that's what happens in the market. People just say, I want to buy Apple at 180 and 190 and whatever, and this brings the price up or down, but it's not the real, the intrinsic value of the company. And that's why we often talk about intrinsic value, which really represents the real value of the company. And clearly it's not easy to understand it if you don't know how to do it, because there's not a price tag on it which says Apple is valued 4 trillions. And so this is the importance of being able to calculate an accurate intrinsic value for a company, especially because for investing you use this intrinsic value to know if over the time the stock price, and so the market value of the company, will grow or not. Because over the time, if the company has a good management with a good strategy, and so it's in a healthy condition, the stock price, so the market value, will always tend to reach the intrinsic value of the company. And so knowing this intrinsic value and the market value will tell you if a company is overpriced or underpriced, and so if you should buy it or not. And so thanks to this value, you can really make better decisions for the long term of your investments. And so to calculate this intrinsic value, actually the best way is to use the discounted cash flow method, on which I'm not going to talk about now in detail because it's not the objective, but just to understand roughly how it works, this value, this discounted cash flow, represents the money, the cash that the company will generate over the time of your investment, which actually means that this is the money that you will receive at the end of your investment, when you will sell the investment. But if you're interested to know more about this discounted cash flow method, just write it down in the comments. I will look to make a video about it. And so now let's see the tool that I developed. It's a Google Sheet template that you can download from the link in the description. And I hope it's useful for you. Clearly, if you have any question about it, just write it down on the comments. I will look to answer to every question. And so here we are, and we have to start by filling the general data table here on the left. So just to know, everything that is yellow is something that you have to complete manually, and don't touch the rest because there are formulas and everything, and so clearly if you modify it and you don't know what you're doing, you won't be able to use it, the template again. And so firstly, we have to decide for which company we want to make the analysis. In this case, I will continue with Apple, company that everybody knows. And so here in this case, we'll just put Apple. And we need now to find the exchange symbol, which means the market on which it is being exchanged. And this is super easy. You just search it on the internet. You can make Apple Exchange, and we will see that it is Nasdaq. Here also we can see the AAPL. It is the ticker that it's asked just after the stock ticker. So we'll have a Nasdaq now, Nasdaq, and just in the case after AAPL. And like this, you will have here the Google Finance formula that will calculate automatically the price and the number of stock outstanding. Like this, as you can see here, you already have the value of Apple, the market value, as well of the stock, so that after you can compare it with the intrinsic value. Now we have to find the discount rate, okay? And the discount rate is actually the value that gives the name to the discounted cash flow method. And without going in its details, it is the value used to convert today's money into futures money. This because over the time price changes. And as an example, $1,000 now are less valuable than $1,000 in the 1960s. And so to do that in this exercise, we'll use the interest rate of the 10 years US government bonds, because it represents the surest investment we can make, and hence it is the minimum return we have to accept for our investments in order to not lose money over the time. And so here you can just write on the internet 10 years US government bond, and we can see that the 10-year treasury rate is at 4.29%. We can also check in here on the MarketWatch. Yes, I agree. It's 4.294. So let's put that 4.294%. Now the WACC, the weighted average cost of capital. This is the average cost for the company, for Apple in the case, to get money from a bank or similar. So let's just search it also in the internet. This is something that you can actually find calculated by yourself, but it's rather complex. And having a margin of security on this calculation, on the one that you find on the internet, is enough to be sure that you are having a good value. So here normally what I use is Finbox. It has a really easy interface. It's really practical. So you can check here, you can find here the 3 different that they propose. And here I usually take the highest one, 10.3 in the case. Why that? Because the higher it is, the more margin of safety you're taking on this calculation, so that you know that you are taking less risk. So going back to our calculator, we put 10.3%. Analyst growth rate or yours. So here we have 2 ways actually to define the growth rate of the company. Firstly, we can take a growth rate we find on the internet, but I would not advise this way, because you don't know how the growth rate has actually been calculated, okay? So you don't really know what's behind this number, but you can also put your own growth rate that you think is the best one for the company. You can calculate it as you prefer and use it there. Or what I normally do, you can calculate the owner's earnings growth rate, which is actually what Warren Buffett is doing. And to calculate it, actually you need the net income, the depreciation and amortization, as well as the capital expenditures of the last 10 years. And to do that, actually, it's more about knowing where to find these values. And yes, it takes a little time to find them, but it's actually very easy. You have 2 main ways. Firstly, you search on the company website. For example, here, if I search Apple filings, I can find everything there directly in SEC filings. As you can see, we're always looking for the yearly reports, which are the annual filings, or 10K. As you can see here, the 10K, it's the file that we're looking for. You have different formats. For example, if we take the last one, we can open the PDF, and here it opened. And what we want to search is always starting with depreciation, which we're already there because I opened it not too long ago. We are searching for these values of first of depreciation and amortization. We can see here the values. I will enter them after. The second thing we are looking is for the net income, which is actually always just above depreciation and amortization. That's why we always start with this last one, because it's only stated there in the statement, whereas net income, clearly it's all over the place. So we have these 2. Then so we can take these values, and we have to repeat this for 3 to 4 financial statements to have all the values. But now the most difficult part actually is to find the capital expenditure. So sometimes we can just try to search capital expenditures. For example, in this case, it doesn't work. What we can do also is to try different ones. I wrote them in the guide to use inside of the intrinsic value calculator, the advices to search for it. Every company has its own way. And for example, for Apple, we can try payments for acquisition, which is something very common. And actually that's the correct one. You see here payments for acquisition of property, plant and equipment. Because what does the capital expenditures mean? It's actually the cost that is needed, the expenses that are needed to maintain the business running in terms of material assets. And so here we have these values, as you can see. And so now we have to fill all these values back in our calculator. So if I take again, you see it's in the same table. I take it back again. We have last filing. So this is one here, 9.3. I will go fast forward because otherwise it's kind of boring. Okay, now that I filled the first one using the Apple website directly, I will show you how you can find on the SEC website, on the SEC of the government. So it's very easy. Here you have the link, you can open it. Here you have to search for Apple, or you can put just a ticker. Here we have Apple. Here, as you can see, selected filing 10K. And here we have all the 10Ks. Can just open to have all the 10Ks, and I will just put all annual reports I can't. Here, this is the last one, so I won't take the one from the year before, since we had 3 years. We have 1 year, 3 year, 3 year. So I will take this one. And here, as you can see, it's the same thing. We can just search for depreciation. We have the values. Here we have again net income. And since we've already found the capital expenditures, we know that it is here payments for acquisition of property, plant and equipment. And so you continue with this flow until it's fully completed your table. Okay, so I've completed the table. Yes, it takes some time, especially the first times when you don't know how to search all these terms. But once you get used to it, it's actually very easy to do it. And what I advise and also what I do, I just save these values over in another file so that I always have them by hand if I need them. So now we have calculated all these values. We can actually just copy these here. In the case you don't want to use the calculated growth rate and you want to use the one from the analyst or yours, you will still need these 3 values to start the calculation of the intrinsic value. So we'll just copy it there. And here, as you can see, we have the owner's earnings growth rate, which has been calculated at 14%. And here also we have another measure, the standard deviation, that I added to better understand if the growth rate we calculated is reliable, because standard deviation actually represents if there's a lot of variation between the results of every year. And so the lower this value, this standard deviation is, the more accurate your growth rate will be. And so in general, as a rule of thumb, I saw that in general, when the standard deviation is lower than 50%, the growth rate is rather accurate, whereas if it is higher, it starts to get less and less accurate. Okay, so here we have this value. And we can also define the desired margin of safety. For example, we'll put 30%. And here in this case, you will just choose if you want to use the calculated growth rate, as we did now, or the one from the... What I normally do and what I would advise is to firstly use the calculated growth rate to see what is the result. And in this case here, we can see in this table, we can see the intrinsic value, which the company is calculated now at more than 4 billions with a stock price of $298. And here the output, which is actually what you're looking for, is that at the moment, if you buy with this growth rate and this price, you are having a 68.9% margin of safety. And so the maximum price to buy the stock to still be in the 30% desired margin of safety, you would have to pay maximum at $229. And here also I put this little formula that just tells you immediately if it is if you have to buy it or not. But what I normally do is I take this owner's earnings growth rate and I tell myself, okay, I want to be really safe. So what happens if the growth rate is 10%? So I put it there. I put back on my growth, analyze my growth. And I can see that the maximum price to buy now is 184.73%, and the actual margin of safety at the moment is 35.76%, which means if, for example, I had a margin of safety of 50%, this would be a no investment, as you can see here, because the maximum price to buy, $160, is actually lower than the price of the stock now. And so working with all this tool, as you see, is actually very simple. The only more mechanical part, let's say, it's just to find these financial values that you have here. But again, if you prefer, you can just find the last net income, depreciation and capital expenditures and decide the growth rate on by yourself. I would say we'll probably be less accurate if you're not making any other type of analysis with the historical data, but it can still be a very good tool that you can use to assess if financially it makes sense to buy the stock of a company. However, what is extremely important also to understand is that this is a tool that calculates you the intrinsic value of a company, but it doesn't mean that you have to invest in the company without doing any qualitative analysis on the company, because the management is extremely important, the strategy of the company, the industry in which it is, and so all the evaluations for the future of the company are extremely important, and you don't know these by these numbers. And so this is the tool that I use to actually invest in the stock market, to calculate the intrinsic value of a company like Warren Buffett, and based on his principles that are clearly explained in the Warren Buffett's Way book, which if you're interested on the topic, on the subject, I would absolutely advise to you. And so if you like the tool and you would like to use it, firstly subscribe to the channel and just then download the tool from the link in the description. And now that you know how to calculate the intrinsic value of a company, I think you also need to know which is the secret of investing, which you can discover in this video. Thank you for watching and see you soon.